Real estate investment practice problem using Excel. Buy home versus rent calculation. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, we got 3 tabs on down below: example, practice, and blank. Let's take a look at them now, starting with the example tab, in essence being an answer key. Left-hand side, we have our information, the information and assumptions in essence that we would be using to make our purchase versus rent calculations on the right. Second tab, then, is going to be the practice tab with some pre-formatted worksheets so you can work through the practice problem with less formatting in Excel. Third tab, blank tab, where we put this thing together in essence from scratch with more formatting involved. Now we're going to go through and make some adjustments to our data on the left-hand side to see what we'd have to do in order to adjust our worksheet and in order to see what the changes to the end result would be. Let's just recap what we have thus far. We have our information on the left. We're going to make some adjustments to it shortly. Then we have the amortization table recreated, our pivot table, which breaks out the information on a year-by-year rather than month-by-month basis. We copied that pivot table over so that we kind of have that information in a hard-coded set of data as opposed to the pivot table so we can reference directly to it. That's going to put kind of a wrench or a glitch in our formatting of the data, so we'll have to do another step in order to format the data due to the pivot table when we make adjustments to the primary data input. Then we got the property value, assuming the value of the home is going up at a rate, I believe, of 2% is what we had it at. So year over year, it increases by the 2%. We then focus in on the cash of flow related to the home purchase, it generally being more complicated than the cash flow related to a renting situation. Because if you're renting, in essence, you're just paying the cash. You don't have all these other kind of things that could complicate the cash flow. On the purchase side, we have other things to complicate it. We're thinking about the cash flow, not looking at the equity first, and then considering the equity that would be involved in the event that we sold the home at any one point in the future. So we got the cash flow before taxes, where we looked at the property taxes, the insurance, the maintenance, and of course the loan payments to see the cash flow in a purchase scenario based on the data on the left-hand side. Then we looked at the cash flow tax savings, in other words, the tax implications that could benefit, including property taxes and interest that might be something that would be deductible. And then we got the cash flow after taxes, subtracting those two related to the purchase. Then we looked at the cash flow related to rent, which we just assumed was $24,000 at the starting point and then goes up by 2%, in essence, inflation for the rest of the time flow period. We subtracted the two out, the rent minus the cash flow from the purchase. So we have a negative cash flow that are these items down below for the 30 periods. Then we considered, well, how do we take into consideration the equity portion? Meaning, what if we were to sell the home? How can we take into consideration the cash flow that would be related to the sale if we sold it at any one time, periods 1 through 30 in years? So we had the sales price. First, we looked at the cash flow, sales price, and then the sales cost, basically the loan, and then the loan balance would give us the cash flow we would receive, not the gain calculation, but cash flow. Then we looked at the cash flow with regards to our tax implications that might be involved. There may be no tax implications if it's a capital gains and it's subject to the exclusion. But if you get large capital gains, then you might have a tax implication. So we tried to cover the tax implication related to it. And then we got the cash flow of the sale after taxes, taking into consideration the tax implications if we were to sell for any of these years on each of these years. Then we put together this kind of complex looking, but once you look at it a few times, this table that gives us an idea of what the cash flow would be, assuming that we sold the property at each one of these years, the sale of the property being the place where you'd actually realize the gain that would happen, realizing the equity or increase in the value of the home in essence. So in year 1, we had the $150,000 outflow. You can think about it as like a capital project outflow in year 1. And then we had the sale and an outflow of the net outflow in year 1 for the $93,845. In year 2, we had the 150 outflow in year 1. If we sold the property in year 2, then we would have basically the net flow from the rent, meaning if we're thinking about going from a situation where we were renting, spending $24,000, and now we put 150 down and we're still paying more even after that in terms of the payment on the loan and so on, then we actually still have an outflow, a net outflow from what we had before after the capital investment, after our cash down payment of the 23.7, which is a little bit different than you might see in a capital project type of calculation, where usually you put the cash flow down up front and then you have a reduction in the cash outflow or cash benefit in the following years. And you might have that situation, of course, here as well, but you could be in a situation even still where you're paying more after the purchase happened. But because the value of the property is still going up and you leverage the property, the equity in the property could grow, fairly quickly depending on the circumstances as well. So then we imagine we sell the property in year 2. Same thing for year 3. We got the initial outflow, and then we've got the net outflow of the amount for the home versus the rent, and then we sell it after year 3. Same for year 4, initial outflow, the net outflows, and then we sell it. So we can then see at the bottom line in our cash flow, we still had negative cash flows because this is kind of an extreme scenario all the way up to the 16 years. Now we have a positive cash flow after 16 years, but it's still pretty low in terms of our IRR, our rate of return. In other words, we possibly could have taken this cash flow, this net amount, and invested it somewhere else and got a higher return on it. So we start to increase the return as we go out, and all the way out to 30, we're at the 2.05. Now we could change the data and say let's make some changes and make it see what it would look like over here. So we might want to say, okay, well, what if we got all this data that we could change. We could say we purchased the house for some other amount other than the 750. We could say the initial rent, maybe our rent isn't 24,000 and we have some initial rent starting point that would be different than that. Of course, the rental growth rate, that would be kind of like the inflation rate, what we would expect to go up. So 2% seems kind of reasonable in normal time periods in the United States, but it could be more or less depending on the circumstances. The growth rate, the property growth rate, here's one where you could assume the property growth rate might outpace, say, the rate of inflation. So you might assume the growth rate is higher than that, but of course you want to run different scenarios, best case and worst case, in the event that you're depending on the sale in order to achieve or get back the cash flow, which you're going to need for some other purpose. Obviously, if you have the cash flow to invest for a longer period of time, then you have more leeway to do so. The insurance and maintenance, obviously those could change on your initial insurance and maintenance, whatever they would be at that point that you would estimate. The expense growth rate, probably around inflation rate as well. So once again, like 2%, it's probably pretty average for the growth rate of the expenses. The marginal tax rate, that's going to be whatever it's going to be. It's probably your highest tax rate that you're looking at, not the average tax rate. And then the capital gains rate is going to be whatever it is going to be in your particular circumstance. The property tax, again, is going to be whatever you would think it would be in your area. And then the selling expenses could be, you could change the selling expenses when you sell, and if you think it's going to be more or less on the selling, but that would be fairly fixed. Then, of course, you could put more down with regards to the loan, which is another big change that you can make. If I have the same sales price on the home, maybe I put more down on the loan, and then more down payment, more cash up front. The interest rate, of course, could change, and then you could adjust like the loan terms and so on. So those are the things. Now, I'm going to adjust basically the purchase price and assume, what if we purchase less here and say bring this down to like 500,000 versus the 200. And this, of course, will depend on where you live and what part of the country your rent prices versus the prices of the purchase of the home and so on. Let's bring it down to 500. We'll keep the rent at the 24,000 here, which would be the 2,000 a month. And so that should change down here. We're going to say the loan then is still 80% of that, which would be 400,000. So we put then 100,000 down, we would be assuming. So then if we go through this, now what would we have to change on the table? The amortization table should populate automatically. What's not going to populate automatically in this scenario is the pivot table. So the pivot table is going to need to be updated. You can generally right-click on the pivot table and refresh. Now, if this thing on the right doesn't show up, you can go to the pivot table up top, and then you go to the Show the Fields tab here if you want that to show up, or unhide it. Now, sometimes the pivot tables can get a little glitchy, but usually you right-click and refresh it, and you should see the change. You want to check basically the payment item here just to make sure it has indeed updated, which should be the sum of everything in year 1, 31,935. So it looks like it has updated. Now, because we didn't reference directly to the pivot table, we could have referenced directly to the pivot table, but oftentimes you don't do that because if you want to pivot the table in something other than this format, it would throw off your other, references to it. So then what I would do is just copy this. I'm going to take this data right here down to there, and I'm going to copy it, and I'm just going to put that into this other table, which I just hard-coded, paste in it values only, right-click, paste in it 1, 2, 3, just the values. Now this is the table. Now they're just hard-coded numbers with no formulas. This is the table we use to reference back from everything else, hopefully. And if we did so, it should pull everything from this table. And if this table is correct, everything else should hopefully populate then on its own. So notice the totals down here are not the same because these are hard-coded numbers. I'll take the totals out. But if I was to total this up, it would add up to the 985,036, which would be the same here. So that looks good. So now everything else should populate. So the property value you can see started out now at the 5,000. The home cash flow calculations have now been adjusted for it. There's our loan payments at the 31. Looks right. Cash flow tax benefit. So the tax calculation should populate. The cash flow after tax, the rent is still at the 24,000. We didn't change that. And we see this big difference in terms of the cash flow. The rent is still in this calculation, even after we put the 20% down. The rent is still lower than the cash flow over here, but we still have that increase in the valuation of the property. So we'll see what the impact will be. Cash flow sales before tax, the cash flow on the sale calculation should populate. You can see the new 500,000 at the starting point. The exclusion calculation, we had the if formulas. Now we only have the exclusion coming into play at the end at like 25. So we have some tax at the end there. We got the cash flow sales after the taxes. And then we have basically our table here. So now we got the initial outflow. Let's just take a look at like year 6. We had the initial outflow of the 100,000 that we put down up front. And then we had the net outflow, the net kind of benefit that would bring down the payments from the rent. So that's the difference between these payments, meaning we were paying 24,000 in rent and we're actually increased, even though we put down money down up front, to cash outflow yearly of the 3292. So we end up with a net cash, more of an outflow going out. However, that may make itself up with the increase that we're assuming is going to happen on the equity side of things. So we've got cash flow still going out here, and then the value of the property down here, if we sold it, would be a cash inflow. So same kind of scenario. We got the cash outflows all the way down, and then when we sell it, we would be realizing the gain, which could be which is highly leveraged still because we put the 20% down. So that could increase substantially. So we got then, if we sum these up, we got still negative cash flows up until, what is this, year 6, where it starts to become positive, but it's still a low rate of return at this point in time. The 1.13 is low, meaning we could have put this net outflow that we're taking here somewhere else and possibly most likely got a better return. But then the return goes up once again because basically that highly leveraged large asset now going up at 2% is becoming significant. So we got the return increasing over here, and then we get out to the end. It's going all the way up to, let's see, the 5.18 at the end of the day. We got the 5.18 on the return. So that's one kind of scenario. If we changed it again, if we go back on over in here and say, okay, well, what would happen? Let's say if the interest rate, let's bring the rate down to like 4%. Change that. Like, what if we got a 4% on the loan? What would that do? Let's go ahead and refresh over here. Say right click on the pivot table, refresh. Looks like it did refresh. The numbers have changed. I'm going to copy this table here. I'll copy the totals this time. I'm going to paste it 1, 2, 3 right here. Pasting it 1, 2, 3. Looks right. And then if we go all the way to the right and say, let's see what that does. All the way over. It should pull all the way over if we got this set up properly. So now we've got the 100,000 initial investment. If I look at year 6 again, we still have those net outflows, meaning I'm still paying more after the purchase than I was renting. But let's see the bottom, it's lower, it's less of an outflow. And so now we're getting our positive cash flow after looks like year 4, year 3. And now it's at the 3.18, and you can see our return basically going up here as well. We get up to the 8s, so we're getting a more significant return here. Now, the next thing, of course, that you could say, well, I think the housing market's going to beat inflation, right? You could say, well, I don't think, the property rate of growth, I don't think is going to be 2%. I think the rate of growth is going to be like, let's say 7% or something like that on the rate of growth of the property. Now, again, that it could depend on where you're at, but it's quite likely that the rate of growth of the property could be higher than, inflation rate or so on. So let's go on back on over and say, okay, well, let's refresh the table and say 7% property growth rate. Refresh the table, right click, refresh. Did that calculate on the 7%? I think it did if I undo it. Hold on a second. Wait, it wouldn't affect the table. We're going 7%. That's not going to affect my amortization table at all, so that doesn't matter. But I'll copy it over just in case. We'll copy it over. It shouldn't have changed anything there. We're going to paste it 1, 2, 3. Where it changes stuff is right here, where we had the value of the property is now increasing at a higher rate, which means our equity is going to go up more highly. So it should be different over here. Let's go on over all the way over, see what we got. So we still have the 100,000 out up front. We didn't have a change or too much of a change, you would think, on the net outflows, although you could have a change, like the property tax was based on the value. But we should have a change in an increase, a much larger increase in the equity, which again isn't liquid until, of course, we sell it. But that's the increase that could go up on that, again, highly leveraged large amount, meaning we're making money now 7% on the full amount of the property value, which we said was, I think it was 600,000, even though we could only actually invest ourselves with cash the 20% or 100. We said it was 500,000. I think we put in 100,000 or something like that. So we're getting a return at 7% on an investment way more than we could invest if we just had the cash. So that means, but obviously, again, if it went down, if you had a negative return, the property went down, that leverage works against us. So now we got a positive cash flow after year 1 here, even if we were to sell it in year 1. But we only have a return at the 2.52, but it increases sharply. Now we're already at a 19.24 equity, having a big turn upwards, kind of entries 19, 22, 22, 22, and then goes back down to 20, 18, 17. It starts to go back down in the later years. Now that might be because you're getting hit by the capital gains tax after some point in time, a little bit earlier on these items. So I think it's going to go up. Then you got the capital gains, and you also have the state itemized tax deductions, which we capped at 10,000. So that's kind of interesting. If we go over here, for example, we're going to say that we had the increase in the sales, but now we've got these capital gains that are kicking in right here. Now, if we were to increase the capital gains to 500,000, if they were married, for example, just to test this out, say we're married instead of single, let's make this 500,000 100,000, and this is going to be 500,000. So 500,000, and cap that out. We have the exclusion here still kicking in after year 12, and then it caps out at that 5,000. So we had it increase quite a bit there. So let's say then it goes up, it goes back down. We also had a cap on the state tax deduction. Interest is going to go down again if we go out to 12. So there it is at 12. Let's try one more. Let's go all the way to the left and do one more. Let's say it's not going to go up at 7%. Let's say the value goes up. We're going to say property growth. Let's make it more like 4%. So we'll double it from what it was before. And let's say the rent was actually, for more comparable rent calculation, let's say like 3,000 times 12. So 36,000 on the rent compared to the $500,000 property. So then we're gonna go back on over here, refresh. Is there anything here to refresh? I don't think so. This doesn't need refreshing, but I'll do it anyways. Same numbers here. This is the only thing we'd have to update. Right click, paste it 1, 2, 3. Going to all the way to the right then. We're going to say now we've got the increase, and at the 500,000 at the cap, it doesn't really kick in that we would be paying gains until the sale happened after year 20. So then if we look at our cash flow calculations, we've got now positive cash flows, which is kind of nice to see. We put the payment out up front, and then we get a net benefit from the cash flows, us paying less cash outflow after the down payment up front for the purchase of the home versus the renting. So that looks more like a normal capital situation, investment situation. And then you've got the IRR going up sharply in the early time frames. And it still starts to go back down a bit here. And then the capital gains should kick in over here around 20. At period 20, we had it about kicking in. So there we have that one. So again, you can test it out, run different scenarios with it. For the last thing, let's just run some formatting. So I'll do some formatting, do our blue and borders thing. I'm going to highlight this whole thing. Going to say, let's make that border blue. Blue borders. I'm going to make all these blue and bordered. Blue and bordered. Blue borders. This one, we'll do the blue and borders, selecting that border blue. This one, we'll do the blue borders as well. Blue borders, blue and borders. This one as well. Just do it for formatting's sake. For formatting's sake, that's why we're doing it. That's why. So here we got that. Everything's all been bolded already for font's sake. Now we're doing this just for general formatting's sake, not just for the font's sake, but for total formatting's sake. So we'll do this one here, border blue, and I think this is the last one. And then we might want to like make all the columns kind of the same. So we'll highlight all the non-adjacent columns by selecting the column, holding down Control, selecting the non-adjacent columns like so. So this one, that one, that one, that one, scrolling over, that one, scrolling over, that one, scrolling over, possibly that one. Let's keep it there, and then we'll make those all kind of like the same width for professional formatting's sake. So there we have it. I might adjust this back to the original numbers so you have that there when we get to the example problem if you're working with the Excel worksheet on to work along with the practice problem.